If you were asked what comes to mind when thinking about Graphic Packaging Holding Company, what would you say? It's been years since I've made an in-depth analysis of GPK, and if you find the video useful, please hit the like button and subscribe. Let's start with some business fundamentals. So in this episode of Stock Up or Down, we are going to take a deep dive into its financial statements to see if it is time to add it back to my watch list. Net profit surged by around 31% year over year. Debt levels can impact the company's financial health and its ability to service its debt obligations. A higher debt-to-equity ratio may indicate higher financial risk. To calculate long-term projections, you can use the free cash flow growth rate. These ratios can provide insights into the sustainability and health of a company's dividend payments. A lower payout ratio generally indicates that a company is retaining more of its earnings to reinvest in growth or build a cash reserve. While a higher payout ratio might be appealing to shareholders seeking income, it can also signal a greater risk of dividend cuts during economic downturns. The return on assets (ROA) is around 6%, the net profit margin is approximately 8%, while the EBITDA margin is around 17%. These figures illustrate Graphic Packaging's ability to generate profits relative to its equity, assets, and revenue. These targets underscore the company's commitment to sustainable growth and value creation. In the case of Graphic Packaging, this rate approximates 11.55% derived from its 5-year average. The packaging industry often features long-term contracts with major brands, providing some stability and predictability. Additionally, Graphic Packaging's extensive product portfolio and manufacturing capabilities contribute to its competitive advantage. Barriers to entry in the packaging sector include substantial capital expenditures, complex regulatory compliance, and a highly competitive landscape. All these factors work together to create a modest economic moat. The payout ratio, however, is around 50% of net income and 58% of free cash flow. However, analyst earnings estimates are being revised downward recently, which could impact investor sentiment. Short interest, which can signal bearish sentiment towards a stock, is relatively low. This payout appears sustainable, although the recent decline in EPS might put pressure on dividend increases. Managing this debt load remains a key risk factor for the company. While not immediately alarming, Graphic Packaging's liquidity position, indicated by metrics such as the quick ratio and Altman Z-score, is modest, suggesting potential short-term strain. And cash flow growth, manageable leverage, modest revenue growth, and a clean audit history. Its valuation is attractive with solid cash metrics and undervalued multiples. Additionally, closely monitor the execution of vision and cash flow targets, especially regarding the Waco plant, which holds significant upside potential. Financial health shows high leverage, manageable liquidity, and an Altman Z-score in the gray zone, indicating a moderate risk of bankruptcy within 2 years. However, it's crucial to monitor its debt load, margin stability, and progress in executing its growth strategy. Growth potential is solid with ambitious yet achievable targets and a clear roadmap for execution. Dividends are rated as modest with a yield around 1.5 to 1.7%, sustainably covered by earnings and cash flow but slow growth. The moat is rated as moderate with benefits from scale and client relationships, but also significant capital expenditures and competition. Management is strong with a clear strategy and committed leadership. The business model is capital intense, reliant on industrial operations and commodity input costs. Market sentiment is cautious with downward earnings revisions, but the stock potentially undervalued. The price is not significantly impacted by short interest, and insider buybacks suggest confidence in the stock. Finally, risks include high leverage, margin compression, and potential earnings downside. Additionally, the Altman Z-score of approximately 1.85 places the company in the gray zone, indicating a moderate risk of bankruptcy within the next 2 years. Although not in the immediate danger zone, it warrants monitoring. Furthermore, the company faces challenges such as volume or pricing pressure, commodity input costs, and competition, which could compress margins. Lastly, recent earnings downgrades challenge the growth thesis, which could affect valuation and sentiment. Despite this, Graphic Packaging has maintained a stable dividend for about 6 years. Over the past decade, the company's dividend has grown at a compound annual growth rate of about 7% from 2015, when it was $0.2, to today, where it's trading at $0.3. This track record demonstrates the company's commitment to rewarding shareholders through dividends. Applying this growth rate to the latest free cash flow figure of $295 million yields an estimated long-term free cash flow of nearly $830 million. He joined Graphic Packaging in 2017 and is responsible For the company's overall performance, under his leadership, the company has been making significant strides in implementing the Vision 2030 plan. Year-over-year, cash flow growth stood at around 53% in the most recent quarter. Graphic packaging operates in multiple segments, including consumer and industrial packaging. It serves a wide range of industries such as food and beverage, personal care, and e-commerce. This robust growth in EPS and cash flow contributes significantly to the company's value. It highlights graphic packaging's ability to increase its profitability and generate strong cash flows, which are essential for funding growth initiatives, returning value to shareholders, and supporting a healthy balance sheet. The price-to-book ratio, POB, ranges from 2.9 to 3.1. The enterprise value to EBITDA or EBITDA is between 8.7 and 9. These ratios suggest that graphic packaging could be undervalued, but it's essential to consider industry benchmarks and future growth prospects for a comprehensive evaluation. You can learn more about calculating long-term free cash flow by reading the linked article in the description. Earnings per share are approximately 2.36 on a trailing 12-month basis with about 31.8% growth. This model assesses various financial statement line items to evaluate a company's financial health and profitability. A higher score generally suggests stronger fundamentals. We'll delve deeper into profitability later in the video. As usual, I will provide a summary table at the end. The current ratio, which measures a company's ability to pay its short-term liabilities with its current assets, is 1.88, which is healthy. However, the quick ratio, which excludes inventory from current assets, is 0.73, indicating a slightly weaker liquidity position. Both ratios can be found on page 2 of the balance sheet linked below. If you want to skip ahead, you can click on the chapters listed in the description. Before starting, please remember that nothing in this video is financial advice. This is for entertainment purposes only. According to Investopedia.com, graphic packaging's total revenue grew modestly year-to-date at 1.3%, while recent quarter-over-quarter sales are mostly flat or slightly down. As of March 31, 2025, graphic packaging's total assets approximate $11.5 billion and total equity is right around $3.16 billion. Debt to equity, a measure of financial leverage, stands at approximately 1.8 to 1.95. Looking at free cash flow, analysts expect it to reach $400 million by 2026. Some estimates project it could even reach $1 billion long term. The dividend payout ratio is approximately 58% of free cash flow and 50% of earnings, suggesting a cautiously sustainable level. Now let's move on to key ratios, starting with valuation. The price-to-earnings ratio, often referred to as the P or E ratio, is between 11.3 and 12. Regarding profitability, the return on equity, ROE, typically ranges from 25 to 26%. Using Piotrowski's score model, graphic packaging scores 7, indicating strong overall fundamentals. Moving on to growth potential, we can see that while revenue growth is modest, earnings per share and cash flow have been growing strongly. Looking at long-term targets, graphic packaging's Vision 2030 targets low single-digit revenue growth, mid-single-digit EBITDA growth, high single-digit EPS growth, and FCF of roughly $1 billion by 2030. Next, let's discuss the moat and qualitative factors. In terms of moat, graphic packaging benefits from scale and long-term client ties. Regarding management, Michael Doss, the company's president and chief executive officer, is executing the outlined strategy. The business model is capital-intense due to the nature of the packaging industry, which requires significant investments in plants, equipment, and distribution networks. Now let's focus on dividends. The dividend yield is between 1.5 and 1.7%, which is relatively low compared to some other companies in the sector. Market sentiment and price appear to be underappreciating the stock based on the low P or E ratio and solid cash metrics. Moving on to insider buyback and short interest, there have been active share repurchases, which usually indicate that insiders are confident in the value of the stock. Finally, let's talk about red flags. One significant concern is the high level of debt. Let's summarize the findings in our assessment table. In the fundamentals category, I rate graphic packaging as profitable with modest revenue growth, strong EPS. Key watches should focus on debt reduction progress, interest cost management, and margin stability amid raw material inflation. Overall, I rate graphic packaging holding company as hold. It presents an interesting opportunity with strengths in valuation, profitability, and growth potential. Thank you for watching. Please don't forget to support and subscribe. See you in the next video.